truths to be self-evident.
That all men are created equal.
As a member of Congress, I get to have a lot of really interesting people in the office. Experts on what they're talking about.
This is the podcast
for insights into the issues.
China, bioterrorism, Medicare for all. In-depth discussions.
Breaking it down into simple terms. We hold these truths.
We hold these truths.
With Dan Crenshaw.
The Eagle has landed.
Welcome back, folks. It's tax season. And if you didn't know it's tax season, it's tax season. So I wanted to have a conversation then about tax policy in today's episode. And for that conversation, brought on Scott Hodge. Scott is the president of the Tax Foundation and is recognized as one of Washington's leading experts on tax policy, the federal budget, and government spending. So he can help you do your taxes. I think that's what we're saying here. Scott, thanks for being on.
You bet.
Appreciate it.
Thank you very much.
I'll go into a little bit more of your background here. So you've led the development of the Tax Foundation's most successful programs, the Taxes and Growth Dynamic Tax Modeling Project, the State Business Tax Climate Index. You were one of the driving forces of tax reform that culminated in the 2017 Tax Cuts and Jobs Act. In the 90s, so you've been at this for a while. You helped develop major components of the Contract with America. That became the centerpieces of the 1997 tax bill and the Bush tax cuts in 2001 and 2003. Written a lot of books, written a lot of articles. You're the guy to talk to. Okay, so tax season is coming up. What should people know? Do you have some general advice that you would give people on how to do their taxes better, or just hire an accountant?
Well, between you and me, I use TurboTax like everyone else, but this may be one of the most complicated, confusing tax seasons we have seen in decades. And a lot of it came about because of the various relief programs that were put in place in 2000 especially 2001, in which the Biden administration put together these huge relief packages with the expanded child tax credit in particular. And of course, a lot of that was sent out in advance, and so people got those month-to-month checks as part of that child tax credit. Mm-hmm. Now, for a whole variety of reasons, people may be filling out their tax form this season and finding out that, one, we have to figure out how much more of that child tax credit they're going to get in this tax return compared to what they might have gotten. And so it's going to be a very, very complicated mess this year. Some people may end up getting less in a refund than they might have expected, and other people may get more. And so one of the problems is that the IRS was doing its best to try to implement these various relief packages last year, but I think the end result is that taxpayers are going to be very confused, and they're not going to get much help from the IRS. That's the big problem. One of the National Taxpayer Advocate at the IRS just reported to Congress that the IRS is behind by 23 million returns from the last 2 years. So it has this huge pile of returns that it's still trying to get to from previous years. Meanwhile, it's trying to answer our questions for this year.
Well, they got to mine. They told me I owed more. So I guess for people who owe more, they're very quick to get back to you.
Yeah. But if you have problems, and believe it or not, we're getting calls from people who are due some of the relief from 2020. There were businesses that were supposedly due to get some of the taxpayer relief back in 2020 that are still waiting for those refunds. Mm-hmm. And so I think, what's the point of providing relief to people if it comes 2 years later?
Yeah, I mean, is this one of the big problems with tax policy in general? You've got a very complicated system that nobody can really navigate. The Tax Cuts and Jobs Act was, one of the ideas was to simplify it. I don't think we ever got to any simplification, to be honest.
A little, yeah.
And there's all these credits, there's all these deductions. I think if we were to create a tax code from scratch, we wouldn't have any of that. But it's very difficult to claw them back. Because once people are used to filing them, it's not that complicated for them anymore, I suppose. And you've built a constituency for whatever deduction or whatever tax credit. And it just ends up being confusing as hell.
I'll be honest with you. Both parties are responsible for this. And over the last 30 years, the succession of implementation of child tax credits, adoption credits, energy credits, education credits, housing credits, you name it, there's a program, and it's all being run through the IRS, including big things like Obamacare and other sorts of programs. The IRS has become a super agency over the last 30 years.
Right, because we're not creative enough to solve problems in any other way except through tax credits.
That's exactly right.
Like at first glance, it's not crazy. I mean, you want to provide an incentive for behavior that you think is good. But
yes,
does it really work out?
The tax code may not be the best way of doing that.
It's become a catch-all.
Well, what's happened is that the IRS is now a benefits agency, not just a tax collection agency.
Yeah.
And Congress needs to figure out what it wants it to be. And the longer that we make it a benefits agency, the more bogged down it's going to become, the more complicated the tax code is, and the more difficult it is for the IRS to actually respond to the problems. That's why it's only answering 11% of all the phone calls that it gets. And we simply need to decide, do we want this to be a benefits agency or a tax collection agency? And I think a lot of these programs that are being run through the IRS should be run through other agencies in government, whether it's HHS or housing or energy or something else, but not through the IRS.
How many tax credits are out there? Any idea?
Well, I should know this off the top of my head because one of my colleagues just wrote a paper on these things, and they've expanded dramatically. The child tax credit now is in the hundreds of billions of dollars between the actual credit itself and the refundable aspect of the credit.
Let's explain that, what that means for the layman.
Yeah. Well, when we get a tax credit, we use that to lower our tax liability. So let's say you owe $1,000 in taxes. Once you've gone through your entire form, you've taken your charitable deduction and some other things. So you owe $1,000. However, you have 2 children, and you theoretically would get as much as $4,000 in tax relief.
Okay.
So a tax credit would eliminate that $1,000 liability. However, these credits have been made refundable, which means you get the remainder of the credit.
Yeah, you're getting a check for another $3,000.
You're getting a check for another $3,000.
Good deal. But you get it at the end of the year.
You get it on April 15th.
It's not like right when you get your
correct
when you have your child.
Now the difference was that Democrats tried to implement such a thing through last year in those monthly checks that they sent out or had the IRS sent out to people, and that's what's made this year so confusing. So you got half of that additional relief last year in those monthly checks.
That's what you were talking about.
And then you get the rest of it this time, and that's just really made the system so complicated, and will make it really difficult for some people to figure out what they're actually owed.
So Republicans, I wasn't in Congress yet, but when they passed the Tax Cuts and Jobs Act, but they, correct me if I'm wrong, doubled the child tax credit.
Correct, from $1,000 to $2,000.
Now Democrats want to double or triple it again.
Raise it to $3,000 for kids above the age of 6 and $3,600 for children under the age of 6 and
you
under.
can claim it every single year that you have a child.
Yes,
okay.
yeah.
So I think some people might think it's just when you have your first child or when they're born that year. But no, it's all the time you can deduct.
That's right, through age 17.
And it kind of gets to this more philosophical policy question. Well, it's a practical policy question too, which is what's the limiting principle? Where is enough enough? Was 2,000 too little or too much? Is if 2,000 is better than 1,000, then why isn't 3,000 better than 1,000? And it's like at what point do we end this?
Well, let me be honest with you. And you mentioned in my bio that I was helpful in getting the contract with America through Congress back in the early 1990s. Well, the key cornerstone of that policy was the $500 per child tax credit. So I was very instrumental in helping to push that policy. It turned out to be somewhat of a mistake in some regards because we taught Congress the wrong lesson about tax policy. Yeah. We taught them to use tax policies like pork barrel spending, where we're trying to benefit certain constituencies that we want to help. I mean, it's a good thing to want to help the middle class, but we overdid it. Yeah. And so as a consequence, the latest estimates are that somewhere north of 55% of all taxpayers in America have no income tax liability because of the generosity of these tax credits and deductions that we put into the code. So now you have, I dare say, a caste system in America which we have a smaller and shrinking number of people who pay all the income taxes, and a growing number of people who look at April 15th as payday and not tax day.
Yeah.
And that's a problem. Because
I used to look forward to April 15th when I was in the military, because basically everything is deducted when you're in the military. That's no longer the case.
Well, look, I understand the sentiments in trying to help people, but the IRS is not the proper vehicle to do that. And we're seeing it now. The IRS is simply melting down right now. It cannot function as a benefits agency.
So Democrats say that we should hire more IRS agents, and Republicans just hate the IRS just in general. Because but I mean, I look, if I could paint a perfect world, I think the obvious answer would be make it less complicated so that we don't need more IRS agents. But since there's no plans to make it less complicated, do we need more IRS agents?
Well, obviously, simplification is the key to all of this. And going back to ground zero. Yeah, and as you say, if we were to create a tax system from zero, would we have tax credits for Teslas? Would we have tax credits for solar panels? Would we have tax credits for all these different things? No, we wouldn't. It would be a very simple system that did the least amount of harm to the economy as possible while raising the amount of revenue that the government needs to function. That's the sole purpose of a tax system. It's not to dispense benefits. It's not to reward people or punish other people. And unfortunately, we really have turned the tax system into either a benefit system or a system in which we're trying to penalize people as well.
So can we talk about the history of maybe some myths and some corrections to these myths of the Tax Cuts and Jobs Act? I remember Democrats saying this was tax cuts for the rich and all that, and big corporations.
Yeah.
Let's get to some of those myths. But what are some of your favorite parts of the tax cuts in 2017 that you think helped America?
Oh, there were two things in particular on the business side that were critically important. One was lowering the corporate tax rate from a globally high 35% down to 21%, would put the U.S. now in a very competitive position globally, so that U.S. companies can now compete against countries with much lower tax rates. The other very, very important thing it did was allowed businesses to write off, or what we call expense, their capital investments. That's everything from delivery trucks to machinery to manufacturing equipment to the tools on your desk. All of those things companies were able to write that off immediately rather than having to amortize or write them off over a long period of time. So what that did is it lowered the tax costs of investing in your business. And ultimately, that means you're lowering the tax cost of investing in the United States.
Yeah.
And as a consequence, we saw a huge boom in the amount of capital investment, which is really, really good for the economy. And that's why the economy was doing so well up until the time COVID hit. The unfortunate aspect of the Tax Cuts and Jobs Act, because it was time limited, some of those policies, like the expensing provision, are starting to phase out next year. So the benefits of that extra capital investment will begin to go away. Our models show that expensing, or what we call full expensing for capital investment, is the most powerful economic tool in the tax toolbox because it has such an incentive effect on capital investment. That's so good for the economy, especially when right now we're trying to get companies to onshore things from abroad, to invest more in things like pharmaceutical manufacturing and other kinds of manufacturing, even investing in renewables and things here in the United States. That would be a very powerful ingredient to long-term economic growth. But we have to make it permanent rather than allowing it to phase out. So those two things in particular were the most powerful economic engines in the Tax Cuts and Jobs Act.
What did it do to simplify your annual taxes?
Good.
For regular
there were
people?
lots of good things. I mean, it was not a perfect tax reform by any means, but one of the things it did for individuals was to extend or expand the standard deduction. And what that did is it reduced or eliminated the need for millions of people to itemize their taxes. So they no longer had to find all those receipts and remember all those things that they did. And now they can just file a standard form.
For normal people, like what kind of things are deductible?
Well, there was obviously state and local taxes. There's your mortgage interest. There were some other things, healthcare deductions and some other things like that.
Okay.
There weren't a lot, but at one point we had over 1/3 of all taxpayers itemized. Now, fewer than 10% or 1 out of 10 has to itemize. And those are largely high-income people. The other thing I thought was a very good thing to do, and that was to limit the state and local tax deduction to only $10,000. Now, while folks in New York City and New York and New Jersey and Connecticut and California and Illinois are all squawking about this and saying this was terrible for them, it was good for America, because what it did is it equalized the treatment of the state and local tax deduction across all states. And of course, folks in Texas without an income tax, many of your constituents probably never had to deal with it. But folks in high tax areas, that was a huge benefit because they got to shift some of their tax burden to Washington.
Right.
But by equaling, this is a fairness issue by keeping that state and local tax deduction at $10,000. And that means every taxpayer in every state is basically working under the same rules, and that's critically important.
So Democrats have a couple complaints. Well, not just a couple, but some of their big ones are corporations don't pay enough in taxes. It drives them crazy that a corporation might not pay any taxes. Maybe at the end of the day it doesn't, because of the various deductions that it has, and you end up with a real rate of close to zero. They'll point out, and I don't remember what the figure is, but they'll point out that while it's 21%, it's actually much lower because of all these deductions. I mean, and you mentioned one of them, right? You can deduct, your capital expenditures.
Yeah.
So, and for us on the Republican side, we're like, yeah, that's the point. that's a good thing. Who is getting enriched necessarily when a corporation is paying less in taxes? Who's getting hurt by this? It's another interesting question, because they make it sound like you're getting hurt, but are you? And then of course the second part of that is the inequality argument, and that the rich don't pay their fair share. That's probably a longer conversation, but let's stick to
start with corporate.
Yeah, let's start with corporate.
Yeah, well, economists look at this very differently, and they kind of separate the issues between the taxes, the checks that corporations write to the tax collector, and the economic consequences of the corporate tax. And the studies have shown, in fact, one particularly important study that was done by the OECD, it's the Organization for Economic Cooperation and Development in Paris. It's the member organization of developed countries. They did a seminal study about 10 years ago, and they determined that the corporate income tax is the most harmful tax for economic growth. And why is that? Well, because it's taxing capital income, and they determined that capital itself is the most mobile factor in the economy. It can flee thanks to high tax rates. It's very, very sensitive. And so they found that the corporate tax is the most harmful tax for economic growth. Another recent study found that when you look at who actually bears the economic burden of the corporate tax, that its workers bear at least 51% of the burden of the corporate tax through lower wages. And of workers, the most harmed workers were younger workers, less skilled workers, and women workers. And why is that? Because they tend to be sort of the marginal worker, if you will. It's women going back into the workforce. It's younger people trying to get their foot in the door. It's less skilled people trying to get that first job. Those are the ones that are hurt by the corporate income tax from an economic basis. So we can even set aside this notion, well, they're not paying their fair share because of all the deductions. Well, get rid of the deductions if you don't like them. But we ought to look at the economic consequences, and that's really profound.
Yeah, and it's a part of it too is they just see corporations as bad. Like the word corporation makes some people's skin crawl, and this isn't just the left, by the way. This is our populist right too.
I know.
I've seen plenty on the right agree with Elizabeth Warren on this. So they're not real conservatives; they're more populists. And there's some of the same people that think we should have given $2,000 checks out at the end of COVID. I remember that. I'll never let the right forget that. Because there was a lot of people that said we can only win Georgia Senate races if we start giving out free money. You got to do what's right for the people. Oh my God, imagine that. The people want free money. I can't imagine. But I remember those COVID tax credits. They're not even tax credits. They were just COVID stimulus payments. Going out to well over, I remember some figures on this, going out to well over 100 million people that never lost their job. Yeah. And we think that's okay. Anyway, I like to complain about that a lot. But so I'm not going to let the populist right off the hook on this either. What is it? And I'm almost asking you a psychological question. I'm trying to figure, because I'm always trying to figure this out. Yeah. What is it about corporations that makes their skin crawl? I don't necessarily know. And what is it? What if you raise their tax rate? Yeah. I don't understand what benefit they think will come from that.
Obviously, in being in this business now for over 3 decades, I've been wrestling with some of these same questions. Why do people hate the rich as much as they do? Why do they hate corporations? There's certainly some envy there. There's also, I think, and this is particularly the case among populists, the belief that when one person got ahead, it came at someone else's expense. They see the world in zero-sum terms. They see the economy in zero-sum terms. So Jeff Bezos becoming a billionaire must have meant someone else is worse off. Mm-hmm. Now, I don't believe that. And I don't believe that the hundreds of thousands of people that work for Amazon believe that either. Yeah. When you see people get rich the way he did, it came through entrepreneurship. It came through risk. And it's something that sets the U.S. economy apart from other economies. I've lectured enough in Europe, and I've been asked this question: why does the United States have Amazon? Why does it have Google? Why does it have Microsoft? Why does it have all these big companies and Europe doesn't? And it becomes, we are tolerant of risk. We encourage it. We celebrate it. We celebrate the fact that entrepreneurs can fail multiple times until they get it big. In fact, the whole idea of venture capital is built on this notion of risk. Venture capitalists will invest in 10 companies knowing that only 1 or 2 are going to strike it rich and do well. In Europe, they have a completely different attitude. It's very risk averse. So if you failed once, chances are you're not going to get more investment the second time because, oh gosh, you couldn't make it that time. And so that's the basis of it, is this idea of a zero-sum economy.
It's resentment politics. That's what populism is. It's fundamentally very emotional, very, very much based in resentment. Yeah. And what I would ask them is, look, do you think Amazon's going to go under because we increased the corporate tax rate to 40%? No, they'll figure it out. They'll survive. They'll cut a lot of workers. Yeah. They'll raise your prices. Yeah. But Jeff Bezos will be just as rich as he ever was. Who won't survive is the small businesses. Right. They will not survive. They haven't made it yet. Yep. And Republicans need to be for what I would just say is small business economics. What are the economic policies that work best for small businesses? And that really that drives our policy thinking. It doesn't force us to change anything either. I mean, it's basically what we've believed for a very long time, but we've never made the argument. We've got to label it small business economics because that's just what we actually believe in. What is the best regulatory environment, best tax environment for small businesses? If you're just starting, if you don't have a team of lawyers, if you're just dipping your toe in, So let's talk about the idea that the rich don't pay their fair share. Yeah. What's the truth here?
Perhaps one of the biggest myths out there, and it's very, very difficult to provide people with facts and convince them otherwise. So when I ask people, how much of the income tax burden is borne by the rich, the top 1%, mm-hmm. and they don't know. Well, it happens to be nearly 40%. Yeah. So the top 1% of people, that's about 1.5 million people, actually they're taxpayers, and most of them are businesses, they pay 40% of all the income taxes and 25% of all federal taxes. And you say, well, they got all the money. Well, if you look at the amount of share of income, it's only 20%. Mm-hmm. So if the tax system was proportional, if you paid the amount in which your income was, they're paying twice that share. And you say, well, but they get all those deductions, and they got all those loopholes and lawyers and stuff. So what's the average tax burden for the rich? Well, it happens to be 30%. So 30 cents out of every dollar they earn, on average, goes to pay federal income taxes. That's at least twice what the average taxpayer pays. Mm-hmm. Those are the facts. Very difficult to get people to understand that. Another thing that's really interesting is that a study came out of a French think tank last year that compared the tax systems in Europe to the tax system in the United States. They found out that they determined that the U.S. has a much more progressive income tax system than do European systems. Right. The rich in the United States pay a larger share of the tax burden than do the rich in Europe. Our poor pay a lower share of the tax burden than do the poor in Europe. And our tax system is much more redistributive than any tax system in Europe. That shocks a lot of people to hear that. Because
I brought that up in a budget committee hearing last year, and it's one of the Democrat witnesses. He's an economist, and he, of course, knew the study. Yeah. And I bring that up, and he's like, well, that's only if you include all taxes, state, local, and federal. Then you come up with that number. And I was like, what other kind of taxes are there besides all of them?
He's wrong. He's actually wrong in that. But, there's a huge misconception. Mm-hmm. And we do more through the tax code to redistribute wealth than do any European countries.
But one thing people, which I think understandably complain about, let's go back to Jeff Bezos. That's what I wanted to bring up. That's what I forgot earlier. Yeah. Back to Jeff Bezos. So, look, he's created a great thing with Amazon. There's an argument over whether Amazon's great. I understand that, and it's actually a pretty interesting argument between brick and mortar stores and the online stores. Mm-hmm. Whatever. Let's move past that for a second. Mm-hmm. People obviously like what he's doing because they use Amazon all the time. Yes. But he doesn't pay income taxes, and he has some loopholes that people don't like. Right? He basically gives himself loans. And so he can he can take out a loan, use that as his spending money, and pay that back through sale of stock, something like that. I'm not sure I'm describing it exactly how they do it, but he's not the only one who does this. There's various others.
Elon Musk.
Yeah, they do it this way. So, look, I understand that people are a little annoyed with that, and especially people who don't really pay 30%. I mean, people who are wealthy, let's say upper middle class, I think they're paying a lot more than 30%. Yeah, probably. Because they generally are upper middle class through a salaried job. It's a very good job. Maybe they're getting $1 million a year, but they're definitely paying. And if they live in California or New York, they're definitely paying half their income. 6 months out of the year, they are giving that to the government, state and federal. Yeah. So I can see why people are pissed off. Now, of course, they don't tend to be the ones that are pissed off about this. It's people who, as you know, actually pay net zero or negative taxes. But again, is there a way to even solve the tax collection issue, let's call it, that I just talked about? Because it does seem like a loophole. The only idea I've ever heard that could come close to solving that would be a minimum wage for CEOs, which is completely the opposite of what the Democrats want. Like, they want caps on it. Well, if you want them to pay the taxes you want them to pay, then you need to require a minimum wage, because right now their wage is zero. Yeah. So anyway, what do you think about all that?
Well, a lot of it comes down to the way that we tax businesses and the way we tax capital income that creates a lot of this confusion. Business income, or at least corporate income, is taxed at least twice. Mm-hmm. So first, Amazon goes out and they make $100 million. They pay 21% on that in federal taxes, so that reduces it. They're taxed below 80%, or their income, after-tax income, below $80 million. But then the shareholders pay an additional tax at the individual level on either the dividends that the company pays out, or on the capital gains in which they sell their shares.
Sure.
So that means that that income is actually being taxed twice, which is unfair. And so what Bezos is not doing, if he's not paying, quote, income taxes, if he's not making a salary, he's not paying that second layer of tax on that corporate income. He's delaying it perhaps until he decides to sell it off and buy out, another Blue Origin rocket ship or something. And that's what it's hard for people to understand. And I hear people like our friend Ron Wyden from Oregon, Senator Wyden, say, capital income ought to be taxed like wage income. I agree. Wage income is only taxed once. Capital income is taxed 2 times, sometimes 3 times. Taxed at the corporate level, taxed again on capital gains and dividends, taxed when you die, 3 times. Now the Biden administration has proposed a new crazy kind of tax in which this sort of quasi-income wealth tax, what they call the billionaire's tax, it's a wealth tax on capital income, on capital markets. The crazy thing about this is when they're trying to propose this, inflation is now a 7% tax on the American economy. The Fed is about to raise interest rates in order to slow the economy to reduce inflation. And now the Biden administration is coming forward with $2 to $2.5 trillion worth of new taxes, most of that aimed at the capital market. So the market is already nervous about rate increases coming from the Fed. They're nervous about inflation. And now they're going to get hit with these high taxes. It's completely insane.
I wonder how good of a chance they have at passing that. We saw Build Back Better go down in flames. That doesn't mean they won't try to regurgitate some, or bring back some of the bad parts of that. A couple of things that come to mind as you were talking was, you skirted my question, by the way, about
Really?
Jeff Bezos. Well, frankly, to your credit,
how do you deal with it? Well, what he's doing is he's deferring paying tax on unrealized gains, and that's what the Biden administration did. They don't like it. They don't like the fact that people can delay paying taxes on paper gains.
Well, they also don't like that.
These are paper gains.
I mean, he's rich because of his net worth, and that net worth is not necessarily liquid. He doesn't have just billions of dollars in the bank, but he does have stocks that are worth billions of dollars. And the other thing Democrats would say is that what they also don't like is that the tax he is paying on that, isn't it 20%? Capital gains?
Yeah, 20%, plus the Obamacare surtax, that's 23%. Roughly.
Right. So again, I think the resentment comes from that upper middle class person, still making good money, but paying way more in a tax rate.
Well, let's go back again. That capital income that's being taxed at 20% or 23.8% is a second layer of tax on that capital income. The corporation has already paid tax on that income before it distributes it to its shareholders or before the shareholders sell their stock and pay capital gains. So that's a second layer of tax on that. And we have...
But it's not paid by the same person.
It doesn't matter. To the economy, it does not matter.
Yeah.
To capital investment, it doesn't matter.
We're speaking in emotions here, because we know why people are upset.
I know.
It's hard. I guess there's not a good answer to this question. I acknowledge that, because it's hard to zero in on some of these loopholes without severely screwing up the rest of the system.
Yeah, I think the solution here is to rationalize the way that we tax businesses in America, to try to get all businesses to a point in which there's really only one layer of tax. The Ukrainians, excuse me, there are better tax systems out there that we can look to. Estonia has a wonderful tax system in which businesses don't pay any tax until they distribute those profits to shareholders, in which it's taxed at 20%. And that, which means they get to retain all those earnings and reinvest it in the company as long as they want. But when they distribute it to shareholders, it's taxed immediately at 20%.
So that solves that double taxation problem.
It solves the double taxation problem.
It's a pretty simple fix. What about, this is one of the more concerning things, which you didn't mention coming out of the administration, is the this idea of a global corporate tax.
Oh gosh, yeah.
How on earth is this even remotely feasible to establish? I mean, what would they even do?
No. And again, there are multiple issues here with a global minimum tax. One is the economic consequences of this, and that it will essentially throw sand in the gears of global capital investment, cross-border capital flows. It'll throw sand in the gears of foreign direct investment. It will be generally bad for the global economy. The really, I think, maddening thing about it is that the U.S. this is a form of sort of the U.S. beating up, or actually bigger countries beating up on small countries that have lower taxes. So they're trying to essentially run roughshod over the sovereignty of countries such as Ireland or Estonia, or these other small countries that can only be competitive through lower corporate taxes. And yet we don't like that. So we're going to create this sort of global tax cartel of the big countries, and then force these smaller ones to live by our rules.
And would it even be enforceable? Because you can obviously manipulate your tax system in more ways than just the advertised rate.
That's the big question: is whether it's enforceable.
Yeah. And who's going to agree to it?
I think this is going to be like the Paris climate accords, where there's going to be a lot of backslapping, a lot of congratulations, and then nothing's going to come of it except more confusion.
Right.
And you're right. The question is, will these countries abide by it, or will you see, as you will with a lot of cartels, a lot of cheating that goes on? Mm-hmm. And even with things like the OPEC cartel, there's cheating that goes on, and there's countries that don't comply. Right. And I think you would see the same thing with this. Yeah,
it's almost like they, in some ways, it's the Democrats admitting that lower taxes are better and more competitive, but they hate the idea of going against their favored narrative so much, which would be reducing taxes. It's kind of like how they see energy too, right? They know we need more energy, but just not here. It's like we know we need more business and economic growth, but just not here. Right. It's like why are you so against your own domestic production?
Well, they needed a backstop. They knew that they were going to raise the corporate tax rate, which they knew would make the U.S. less competitive.
Yeah, they're admitting
so how do you do this? Well, you go out and you form this cartel with other countries that also don't want to lower their corporate taxes to be competitive, like France, Germany, Italy, Spain. And so then you force these smaller countries to stop competing.
Right.
That is so wrong. It's sort of tax imperialism. We're just going to step in and squash these small countries because they happen to be more competitive.
Let's actually, I want to ask you about let's bring up a show that everybody knows, Yellowstone. One of the big problems in the show Yellowstone, this is more of the state level, okay? But one of the big problems is that the value of their land, because of the way Montana does its taxation system, similar to the way Texas does it. Ironically, California, for instance, doesn't do it this way. And I like the way California does their property taxes better. Now they tax the hell out of you in income taxes, but they do their property taxes in California where, the value of your property is based on the last time you bought it. Okay. It's not reassessed every year. Right. Places like Texas, Montana, it gets reassessed, so it increases. And so the problem with the Duttons in Yellowstone is that if people start creating ski resorts around them and around their land, they won't be able to afford the property taxes on their massive property. And this property that's been in their family for generations will become completely unaffordable to them. Mm-hmm. This gets kind of to the estate tax too, and why that's immoral. How do you give advice to state governments on something like this? Because it seems to be a real problem, especially for some of these family-owned farms and businesses.
There's probably no more contentious issue in tax policy than property taxes. And why is that? Considering it's owning at the local level, it's probably a smaller share of our general tax thing, but it's local. People know it. They see it on their mortgage statement, or they write the check themselves. And we have a team of people that barnstorm around the country working with state legislators to try to fix these problems. And property tax is probably close to number one on the issues we get questions about. And it really is a difficult issue because property taxes tend to go to the things that we need.
Right.
Local public services. And there is a lot of inequities to it. Yes, they built a metro station near my house. My value of my house has just gone up, and so now I'm going to pay higher property taxes. The flip side also works. I live in Washington, D.C. The place 2 doors down from me is a dump, and it's probably lowering my property values. I can't do anything about that either. So, we've got to find a different way to tax property. And to be honest with you, from an economic standpoint, property taxes are the least harmful of all the taxes. Not to say they're not harmful, but they're the least harmful of all the taxes because you can't move land.
Yeah.
I can move a factory. I can personally move from one state to the next, as millions of people are now moving to Texas to avoid the high taxes in the rest of the country. But property taxes are one of those very contentious issues and very challenging to deal with.
Right. It's complicated. So
I'm avoiding the technical answer.
Yeah, you are. That's okay. But let's find some low hanging fruit then. Let's say Republicans were right back in the seat again.
Yeah.
We'll say we take back the House and the Senate, and Joe Biden resigns and says, "I want a Republican to replace me." Okay, let's assume that happens, which I don't think he can do constitutionally, but who cares? Okay, let's assume we have control and we want to pass tax reform 2.0.
Yeah.
What's some of the low-hanging fruit that we didn't get in the first tax reform?
We're trying to promote our own agenda called a growth and opportunity agenda. And the idea here is to change the terms of the tax debate away from progressivity and redistribution to where they properly should be, and that's promoting economic growth and opportunity. And then what I mean by opportunity is the ability for people to improve their lives, to have upward mobility, to be entrepreneurial. And so we've proposed a series of measures, and some of them aren't all that exciting, but maintaining a low corporate tax rate, improving the write-offs for capital investment. For individuals, it means simplifying the tax system so that April 15th isn't a painful day and one that doesn't give anxiety. There are simple things that you can do on the savings side. Savings are very complicated these days. You got, health savings accounts, you got retirement accounts, you got all these different education accounts. We need to bring those together to simplify things for people. And one thing we call the universal savings account, a single account that people can put money into, much like a Roth IRA, I suppose. And once you've saved, you don't have to pay tax at the back end. And Congress and the laws are not going to tell you how you need to use those funds. So we're going to take away all the restrictions and allow you to just save as you want to and then be able to use those. This is a very successful program in both Canada and the UK, especially among low and middle income people. It's a great savings tool. It builds wealth and it builds opportunity.
When can they take out that money and say in Canada or the UK? Is it like a Roth IRA where you have to be 65?
No, there's no restriction on that.
Oh, okay.
Yeah, so once you've paid tax, it's like after-tax income. Once you put it in, you don't have to pay tax on the build-up.
Okay, but you can spend it next tax year? Mm-hmm. Okay. Well, but does that
allow it to build up? And
is there a limit to it, though? Does that so the counter-argument would be that just creates a slush fund for people to avoid taxes?
Yeah, it's kind of like a passbook savings account, but in a much grander way. And that, once you've earned your income, you put the money into the account, then you don't have to pay tax on any of the buildup in that account because, you've already paid tax on it. And again, we're going to take away the restrictions that now dictate how you have to use those savings, and It should be open-ended. There is a limit, I think, in either the UK or Canada. It's like you can put up to $25,000 a year into it. Mm-hmm. We can set that rate at any level.
Right.
So it's not the kind of thing that billionaires can stuff a lot of money in, and it's really aimed at low and middle income people to build wealth.
That makes sense. And so you would be an advocate for a universal savings account, not like an education savings account, a health savings account, all these different ones. Yep. Just universal put one into a universal one. Mm-hmm. Don't really put limits on what you can do with it. Mm-hmm. Okay, what else? Do we need to be lowering the tax rates in any categories anymore?
Well, I would certainly like to,
especially with the debt that we have to deal with.
Well, there's there's a balance between, it's a lot easier to pay off the debt with a stronger economy than a weaker one. Mm-hmm. I think we can clean up a lot of the mess inside the tax code, a lot of the credits and deductions, and lower rates across the board still. Not to the extent of a flat tax per se. I think that would be too difficult to get there. But I do think we need to think about it in terms of, what can we do to spur entrepreneurship, to innovation, to risk-taking, and take the tax component out of those decisions. Mm-hmm. And too much of the code is built around what I call success taxes. So they're taxes on ability for people to be successful, mm-hmm. and we need to eliminate that. We want to encourage entrepreneurship. We want to encourage risk-taking, and so we need to find ways to do that.
Well, it's about the economic incidence, and you've noted that the corporate tax rate has some of the highest negative economic incidence, meaning who does it hurt? And it's taken away from the lowest income workers, mm-hmm. And so another question would be, what about sales taxes? What about gas taxes? And what are these better ways to get government revenue, say at the state level, than property taxes? I mean, these are maybe some questions that we have to answer, and it's always a balance. You're always getting it from somewhere.
Well, that's right. I alluded to sort of the hierarchy of tax harm, with the corporate income tax being the most harmful for growth. Individual income taxes are second most harmful. Sales taxes and other consumption taxes third. Property taxes fourth. So what that tells us economically is we need to start shifting the tax burden away from income-based taxes to consumption taxes, rather than the other way around.
Yeah.
And right now, Democrats are obsessed with raising income taxes and other sorts of wealth taxes, and those are success taxes.
Those policies are based on resentment. I mean, it's resentment for success.
Right. And you're in the same way that a lot of people advocate higher taxes, excise taxes on smoking and drinking, in order to reduce people from doing that behavior. Well, it has the same effect on income, too, and investment. If you overtax it, you get less of it. Well, that's pretty dumb.
Right. On the consumption tax, what they would say is, well, that just affects the lowest income people the most. The same way inflation does, the same way gas does. Things that everybody has to buy. Right. Is there a reasonable way? So I guess one of the other options would be basically a luxury tax or a luxury goods tax. Is that really feasible? Is it easy to categorize?
No, we tried it in the 1990 budget deal under George Bush. We had and under Bill Clinton in '93, we had a luxury tax on automobiles, on furs, on yachts. It ended up, especially the luxury tax on yachts, really killed the U.S. domestic yacht building industry. And a lot of that got shifted to Bermuda and other places where the tax wasn't under effect. And so you have to be very, very careful about trying to target these things with special types of taxes. Now, if we had a broad-based tax, like a value-added tax like they have in Europe, it's affecting all of those products in the same way. So that if Bezos goes out and buys a $100 million yacht, he's paying that 20% tax or 15% sales tax on that, in the same way that if I went out and bought a bicycle, I'd pay 15% on that. So it would be proportional in that way, because a lot of the rich are spending that money on something.
Sure, but but the argument is the lower income person going to the grocery store, going to Kroger's, and spending $100. That extra $15 is a lot to them, whereas that extra $15 million for Bezos, it actually isn't a lot.
We can temper the effects of those things.
Can you exclude goods? Is that a better way?
Well, you have to be careful of doing that,
because
there are lots of stories in Europe of trying to exclude goods. One of the classic ones in the UK, where children's clothing are excluded from the value-added tax. And so what you find is, in a lot of stores, petite women will shop in the teen section in order to avoid paying the sales tax on that. Yeah.
What about food? I mean, would it be easy to exclude food?
Some states, actually Virginia and some other states, do tax food with sales taxes, others excluded. What we try to encourage states to consider is making sales taxes as broad as possible and as low as possible. The minute you start excluding certain items, then the tax rate has to go up because the base is shrinking. And you want a very, very broad base to be economically reasonable. The other thing that happens when you start excluding food is that you get lobbyists coming in to argue why their products are not food. And for instance, or if they are
or
food.
they are food, yeah.
Yeah, so
Like a supplements and stuff,
Twix,
like that.
Twix candy bars in many states are not taxed, but a Hershey's candy bar is taxed. Why is that? Twix has flour in it, that little cake thing on the inside, so it's considered food. Hershey is considered candy and thus taxed. And so then you get this argument about
silly.
the same thing happened with Pringles in the UK, is that actually Procter & Gamble or whoever it was that makes Pringles won that case. And they got excluded because they're considered food.
We're out of time, but that was great. I think we got through a lot there. Scott, thank you so much for your expertise and great conversation. I think we learned a lot. Appreciate it.
Thank you very much.